Okay, guys, good morning. I hope everyone's well. Looking forward to the day now. Pretty interesting yesterday, to say the least, with China. Well, in the briefing yesterday, we kind of missed the big move into the close on the China session, and this really shaped the whole day. Going into the final hour of yesterday's Chinese session, the Shanghai Composite was down about 1.5%, broadly in line with the rest of the Asian market space. But in the final hour, it capitulated and ended up well over 8% down on the session. Its biggest down day since February 2007 for the index. 60% of the companies in the index were halted, limit down at 10%. Without that kind of break, that kind of break system in the index, I mean, the losses could have been even worse. But this really set the tone for the rest of the day, because, of course, the thought process was that the Chinese authorities had regained control of this market through various efforts, quite remarkable efforts. Banning short selling, going way beyond that though, making it illegal for any individual who owns more than 5% of a listed company, making it illegal for them to sell any stocks, extending huge margin lending facilities to the brokers, going as far as to say that the Chinese pension fund is going to start to directly intervene and buy equities. All these measures, desperate efforts to halt the slide. And we'd had a period of calm over the last 2 weeks as the market rebounded, and actually rebounded about 20%. It's just that yesterday, that temporary halt the authorities had created got massively reversed, and today markets opened in China 4% or even 5% down at the open, and then it's been a pretty choppy affair. They've closed about 1.6% down on the day, so adding to yesterday's collapse. But today, initially there was a second collapse at the open, but by the time we get to the close, it's these days I guess a minor down day at 1.6%. So lots of rumours that China's again, the authorities are back in the market. The state-owned banks, their share prices massively outperformed this morning at the open. The gap opened down 5%. It was the state-owned bank share prices that started lifting, which is suspiciously looking like the authorities directly intervening. But still, this kind of risk, this global risk, is back on the agenda. We'd taken a couple of weeks breather on that, but it's definitely back in the focus, and something that unsettled international markets yesterday. Because if you look at these two stock markets I've got at the top of my screenshot here, the S&P had its third big down day in a row, but you've basically got 5 down days straight here from the 21st of July, 5 sessions to the downside in a row. Yesterday's session was down 0.63%. Despite some nice and positive durable goods orders released at 1:30 yesterday, which is good news when you're thinking about the GDP figures we're going to get from the US on Thursday for quarter 2. That's a good signal. Despite that, the equity space globally came off sharply. And look at this technically, perfect test for the S&P of the 7th of May low. So the month of May low at 2,057 was perfectly tested. That brought to an end the sell-off, and then we closed back a little higher. This morning, the market is tracking high, trying to regain some of those losses. You can see that the US markets are better off than Europe. If you check the DAX on the right here, well, firstly, the DAX had a much bigger down day yesterday than the S&P, down 2%, and this morning we're trading not too far off where the DAX index closed. And actually we got some decent data out of Germany yesterday as well, in the shape of the German iPhone number that saw the readings come in slightly better than expected. So despite good news on US data, good news on German data, it didn't stop the global equity space selling off pretty sharply as the China risk, the stock market volatility and collapse, that risk got shoved right back into the spotlight. So all eyes on China as we track through this week. How did this have an effect on commodities? Well, again, more downside. Crude oil took another leg lower. This puts it 25% down now since the May high. Taking us back below $47. We're trading around about the lows from yesterday, today as well. We're trading right down there now. This is important moments for this market, but this is a pretty sharp slide. Just in the last 4 sessions, we were trading up around $51 4 days ago. So here we are down at 47. So that in itself, it's not too. It's about an 8% move to the downside just in the last 4 days. So this takes us back to levels not seen since March. Yesterday's news flow, well, southern Iraq output, so crude output from the southern territories in Iraq reached a record high. So we're continuing to see actually an increase in production from the Middle East, because Saudi Arabia are subtly seeing their output creep higher. You've got output increasing in Iraq. You've then got the Iranian available supply potentially increasing as a result of the diplomatic efforts with the US and the potential for sanctions to get lifted. So this is helping to squeeze things lower. And then on top of that, you've got the China risk, which is sending the commodity space generally to the downside. Copper yesterday, new 13-year lows again. So the China risk is very much a big leader when it comes to the big downside we're seeing for the commodity space. So I talked about this and how this might have a continued negative effect on inflation and how this might shape the Fed's timing on rate hikes. Today sees the start of the 2-day Federal Reserve meeting. So an important part of the week, of course, well, the most important, and they're going to deliver their statement on Wednesday evening. And, really it's the last meeting where there's definitely not going to be a rate hike, if you understand my meaning. There's definitely no rate hike this time. But we then, because the meeting after this one is the September meeting, and right now, and look, oil's just making a new low, by the way. I'm just going to go to a 1-hour chart here on oil and just zoom in on this. So oil's testing the lows. This was a key barrier right the way through yesterday's session, just below the $47 handle. So testing that now. But yeah, in terms of the Fed, this is the last meeting where there's definitely no hike. September, there's about, current estimates, about a 35% chance of a hike. So really we properly move into data-dependent territory after this meeting, where a rate hike could come at any time. But the commodity space going through a huge cycle lower here may well lead to inflationary pressures remaining subdued, therefore buying the Fed more time to wait and leave that hike till later in the year. That's my view anyway. But the Fed meeting starts today, so crude back under pressure right at the get-go this morning at the European Open. European equities, I should say that yesterday's sell-off in the S&P and generally the equity space globally wasn't just China. Well, I guess the secondary knock-on effect of China risk is commodity prices lower. Then this has a knock-on effect to company share prices, companies within the kind of energy and mining sectors. And so certainly the sector that led the declines for the S&P yesterday was the energy sector and the materials sector, both down well over 2% on the day. So definitely the commodity asset class is fairly dominant. There's oil, it's gone, broken below yesterday's low, down to S1 now. So this is again new lows. Now the key level for crude oil, because this is important if you're looking at the September contract chart only. So if you're just looking at September NYMEX crude futures, well then actually this is a new low. Well, let me just check. This is a sorry, I'm just going to check on my daily chart. this is a new, we're extending new lows for the year here. So if you're looking at your September daily chart, just the September futures contract, this is new lows for the year, whereas on the continuation chart, let me go to my daily time frame again, you've got to get back down to $42 before we see a new low. Now this is 25% down from the recent high. This is properly into bear market territory. Support levels here, because we're just moving below this low point we had. So April's low is at $47, so this is really being taken out here. So in terms of technical support on the downside, you've really got very little until you get down to these low points we had back in January, but that's way down at 43.50 area. So huge amount of room to move into here still, despite this being a massive sell-off from $60 just in the last 4 weeks. We still got plenty of room to move lower. So this commodities price squeeze can definitely continue. And when oil moves down and when the commodity space drops, you're going to see weakness in equity markets. So the DAX is now back to flat on the session. Even though the S&P is still up on the day, the DAX is looking a little vulnerable. Yesterday, if we just talk technically, it was pretty clean for the S&P in that we hit the May low and then bounced. Well, for the DAX, I'm just going to add another line in here because we closed the gap. Just going to move that line there. We closed the gap nicely. This is the gap between the 9th and the 10th of July. A gap open higher because of positive developments on Greece meant that this area between 11,150 and basically 11,000 didn't get traded. Well, it broke and got traded yesterday. So this is a classic gap fill. So keep your eye out for that. 9th of July high is important, and then the 11,000 handle. Now, thinking about the euro dollar, the euro dollar bounced pretty sharply yesterday. We had quite a nice negative or inverse correlation between the euro and European equities. That's a correlation we've seen this year coming through pretty strongly. In terms of data, this upside for the euro dollar didn't make too much sense. Well, I guess we got positive German data, but then we got positive US data as well, but that didn't really feed through into a strengthening dollar. So a push higher, and look where we tested yesterday, the 50% fib of the June-July sell-off here was perfectly tested as resistance. So Fibonacci resistance coming in at 111.35, and that capped the upside. Today's low, we've pulled back. Today's low is currently the 38.2 fib levels. This seems to be a pretty influential fib series here, just looking at this overall move from the middle of June down to the middle of July. So maybe get that on your charts and be aware of it. But I would say that this is a bounce, I guess a temporary bounce. Our view is certainly that over the next few months, and certainly as we move into the end of the year, we would be very bearish on this exchange rate and expecting a move down to the 2015 lows, which are just below the 105 handle. But for now, yesterday, pretty big move to the upside. Most of it came in the morning. If we just go to a 1 hour chart, most of it came through overnight in the Asian session, and then as the European session got going. We had a second push higher, though, in the afternoon. This was even after the positive US economic data. But we're trading back down to test those afternoon lows now. So, pretty interesting. On the earnings front, well, earnings yesterday not particularly influential from the US. No major kind of companies reporting, but that's not the case today. We do have plenty more earnings in the mix to be looking out for. We've got companies like Pfizer. Let me just check here on the list. We've got Pfizer, United Parcel, Ford. These are the big hitters who are reporting today. And on the earnings front, generally speaking, we've had over 200 S&P 500 companies report earnings now. And from the revenue point of view, it's starting to look a little bit concerning, because now it's only 51% of companies that have reported so far have beaten revenue forecast. If that slides below 50, and we're at 50.1% at the moment, if it slides below 50 as we track through this week, then that'll be notably, almost like psychologically significant. So keep an eye on that. The earnings per share beats are still healthy, up in the mid 70%, but that is very typical. And companies beating profit expectations mostly is as a result of the expectations themselves being consistently revised lower as you go into the earnings season. So these are very low estimates that are getting beaten. So it doesn't really tell you too much, I would suggest. So more earnings today, plus still thinking about China, plus still weight coming in on the commodity space. We've got the beginning of the Fed meeting. We've got key data in the shape of US GDP hitting the wires on Thursday. So these are all things that are in the mix here. Now let's just turn our attention to today's data, because we've got important news out of the UK this morning. So GDP data, this is first reading for quarter two, so we're going to get the equivalent from the US on Thursday. Now we're expecting a pretty punchy plus 0.7% on the quarter, and this will feed through to an annualized reading of 2.6%. Let me show you this on the chart. This is looking at quarterly growth for the UK out over the last 3 years. Now we had a bit of a dip in quarter one in 2015 where we dipped down to plus 0.4%. So we're expecting a return back up to the levels seen throughout 2014. So we're expecting plus 0.7%, okay, which will be reassuring that the little slip in quarter one was just temporary. Looking at this on an annualized basis, then we're expecting 2.6% annualized growth, which does mean that we're going to slip lower here. And that actually would be the lowest annualized reading since 2013. Okay, but this is because I guess some of those. Let me just get the quarterly reading back on the equation here. This is because these 0.9% readings will now move out of the equation. So we had two plus 0.9% quarters, quarter 1 and 2 of 2014, which were very punchy. Both now fall out of the annualized reading equation. So this is why we're expecting 2.6% on an annualized basis as the first half of 2014 moves out. Okay, so this is the data we're expecting down. Just thinking about, let's say cable, how's sterling versus the dollar going to behave as a result of this data? This is going to be the market to be watching, of course. And here we've got a pretty confusing, a bit, not far off, a bit of a mess here in that we've had let me go to a 4-hour chart because we've got quite a nice pennant scenario on the go here. Just over the last 2 months, this currency pair has been stabilizing within an ever-decreasing pennant, a downtrend and an uptrend on the go at the same time. And so, it'll be pretty interesting to see how this data feeds through. If it's very positive data, well then, of course, the key thing to look for is a break of the high from the 27th of July and then a potential breakthrough of the downward trend line here. Now we broke this briefly last week, but it turned out to be a false breakout, and I guess the key barrier to the upside is this triple top around about 156.70. This is an important level. Any weak data, of course, and this will set up nicely a move back down to the bottom side of the pennant with downside support coming in from the 24th of July low. Okay, so quite an interesting pennant scenario going on as we're trying to just make a judgment after Carney's comments from last week, where there was a lot of hawkish rhetoric coming out of the Bank of England. It's a little bit more confusing now as to the timing of the Bank of England rate hike and then what that compares to the Federal Reserve's timing. So this data that's coming, of course, will be very important. Are we going to get a punchy GDP figure? That would make sense, given that all of a sudden, really from nowhere, the Bank of England massively stepped up their hawkish rhetoric last week. Have they seen the data already, and are they just getting ahead of the game in terms of their communication as a result of some stronger than expected GDP figures? We'll see. So these numbers are coming in at 9:30. Just a quick look at the rest of the day in terms of data. That's pretty much it from Europe this morning, that UK figure. Moving into the afternoon, we of course got the earnings coming in from the US, but then we've got some more housing data. The Case-Shiller House Price Index it feels like we've been getting so much housing data from the US recently. All of it's been very, very strong, apart from the data we got at the end of last week, which was new home sales, which quite weirdly reversed and came in at an 18-month low, even though all the other housing data, pretty much across the board, were coming in at 7-8 year highs. So it's quite weird that we got the new home sales coming in so weak. So we'll see how this feeds through in the Case-Shiller number at 2 o'clock. Then we get services PMI data. These are July preliminary numbers coming in at 2:45. We then get US consumer confidence data, which is due at 3 o'clock. Okay, so this is the data for the afternoon. So definitely numbers to be looking out for, but then just generally thinking about China, thinking about commodities as oil continues to slide lower here. And this should, if oil goes down, equities go down. This is the theme, okay? Despite the fact you might think, well, hang on, cheaper energy, got to be good news for the global economy, got to be good news for companies in terms of their fixed costs. Yeah, that's true over the medium to long term, but right here, right now, oil goes down, energy share prices go down, dragging down the whole index, okay? So let's see how we get on. Enjoy the day.